BTI, British American Tobacco, a stock that is down 20% year to date and is downtrending significantly. However, with a yield of 8.34%, is this a stock that we should be buying to make use of that yield in anticipation for the share price to go up? Today's episode, we're going to take a look at the dividend safety. We're going to run through some really important metrics to understand more about the business. And we're going to end the episode going through our stock valuation model through these four valuation model, look at the intrinsic value and find out with our margin of safety, what is our acceptable buy price and is this stock currently undervalued? So as mentioned before, the stock is down 20%, and if we take a look at the 10-year graph, BTI has returned negative 40%. So if you've been holding this stock for at least 10 years, chances are you've been making a loss purely on the share price appreciation. Now, the earnings per share, 431, forward PE of 7.47. Let's take a look at this in more detail. And one thing to note quickly is that it's right at that 52-week low. So, British American Tobacco, we can see here the dividend safety of 45, meaning it is borderline safe. Market cap of 71.6 billion, making it a large cap company. Now, let's dive in. Key metrics, a few things that I like to look at is this recession dividend. If we're entering a recession, we can see here that over the last recession, 08, 07, 09, the dividend was increased. And during the recession, they actually had positive sales of 4.8%, which is above the average growth. And although the company returned negative 31% return, it did beat the S&P 500's negative 55% return. These other metrics, let's take a look at in more detail. Dividend growth. Now, if you've been watching this channel, you know we like to look for at least 4%, as that's the average inflation rate in the US over the last 40 years, meaning if you're not getting at least 4% return on your dividends, then you are essentially losing your purchasing power. Very disappointing 1% growth over the last year. Again, 4% minimum we expect over the last 5 years, not too bad. However, over the last 20 years, a 10% dividend CAGR is positive to see. Another positive thing to note is that they are 2 years away from becoming a dividend aristocrat. Dividend aristocrats are a company that have paid out dividends consecutively increased over the last 25 years. So some positives and some indicators of items to take note of. Dividend yield theory essentially states a company is undervalued if the yield is sitting above that 5-year average. As we can see here, it's currently offering 8.72%, which is above the 5-year average of 7.17%. Now, one thing to note, as you can see, the yield here of 8.7 is slightly different than what we see on Seeking Alpha. As this company is UK based, depending on the Forex, and if you are a UK shareholder or a US, your dividend yield will be slightly different. However, it's still above 8%. Moving on, again, we can see that the forward PE of 7.5 is below the 8.8 5-year average. So these two indicate there is potential undervaluation of the share price. As always, we never look at one model or one theory in isolation. We like to get a bigger picture by looking at lots of things that we will do later on in the episode. PE comparison, we can see here, BATS is 7.5 PE with the consumer staples at 21.2. As we don't really know what's in this bucket, we're going to use one of our multiples valuation models to take this into account. And as I mentioned earlier, it's trading well at that 52-week low. Now, it doesn't mean because it's at the 52-week low, it's undervalued. Likewise, if it's at the 52-week high, it doesn't mean it's overvalued. And that's where our models will come in. Earnings payout ratio and free cash flow payout ratio. I always like to look at the free cash flow as earnings is susceptible to manipulation through their accounting. Again, tobacco companies around 80 to 85% would be the preference. Looking at the earnings for those that like to see that, it is well below that. And for the free cash flow payout, again, it's significantly over the last 5 years below that 80 to 85%. So I would take from this it's positive and does show that there is really limited reason right now from what we've seen that they would be looking to cut the dividend. However, there are other factors in play when thinking about that we'll come on to. Earnings per share, free cash flow per share. Again, I prefer to focus on the free cash flow, but if we take a look quickly at the EPS for people who like to look at that, 2.17 in 2013, and 2022, 10 years later, 3.71. There is growth there, maybe not as much growth as we'd like to see. However, it's still upward trending, and for me, I would take that as a positive sign. However, one to continue to keep an eye on as the years progress, ensuring that it's at least increasing and not stable or decreasing. Free cash flow per share, again, same kind of comments. 2013, $1.95, 2022, $4.32. Positive to see the upward trend, and I always say I like to look at companies over at least 5 to 10 years, 10 years preferable, as if you only look at a company over a few years, you would see that, say, 2013 to 2015, there wasn't much growth, whereas when you look over at least 5 years or 5 to 10 years, you get a much better picture of a business. Now we move on to the sales growth. Now typically for a steady moderate company, we like to see between 3 to 7%. And as you can see with a BTI, it's slightly different. There have been some years of negative growth, some years of good positive growth, and some years where it has been fairly flat. Now looking at the total sales here, 2013, 15.3 billion, and 2022, 27.7 billion. Again, it's increasing. It's not increasing year by year. There are some years where it does decrease. However, over the grand scheme of things, over the last 10 years, it has been increasing, and I would expect it to continue to increase for the next 10 years. However, I would still recommend looking at their accounts yearly and quarterly just to ensure that there are no issues there. Shares outstanding, one thing we love to see is when this is declining, as it shows that companies are returning excess cash to shareholders. However, when we see the opposite as we're seeing here, they're essentially diluting your position as a shareholder, and therefore this would be a negative in my opinion, as essentially the share price would then decrease because there are a lot more shares on the market. As we can see here, negative in my opinion, not really too much to worry about as it's not that much over the years, and as we can see from 2018 to 2022 it's remained fairly flat. Now return on invested capital, ROIC, one of the 7 golden dividend metrics, I like to see at least 10%. With BTI we can see from 2017 to the current year it's remained below that. Whilst it's not a massive red flag for me, I would like to see this start to trend back upwards how it was from 2013 to 2016 with these double digit numbers. Operating margin, free cash flow margin, very positive to see, above 25%, and BTI have done that year on year over the last 10 years, and the same to be mentioned for the free cash flow margin, above 20% year on year, so very positive to see. Now, one thing just to note, this is probably where it could be slightly questionable in terms of their debt level. So when we look at their net debt to earnings before interest, tax, depreciation, amortization, we like to see below 3. What this means is, for example, 2022, it would take BTI 2.96 years to pay off all its debt, net cash on hand. Again, whilst this would normally be something to look at for tobacco companies, I don't think it's a major cause for concern for BTI currently, given that for the large part it's been below 3. 2017, 2018 and 19, it's been above that, but again it has come down, so I would just be something to monitor, but for now I wouldn't say it's a massive red flag. Likewise, net debt to capital, 2022, 34% of the company's financing is from debt as opposed to equity. We like to see below 0.5, and over the last 6-7 years from 2017 onwards it has been below that, so again nothing really negative for me to say. As always, if you've been enjoying the content, smash the like button, smash the subscribe button. We're now going to jump in and look at the stock valuation model. We're going to start with Graham's valuation, and effectively what we're doing here is inputting the earnings per share and the growth rate. I've gone for slightly more conservative estimates. Analysts had around 12 to 13%. I've gone for 10, and for the yield on AAA corporate bonds, we input that 4.64, and this gives us an intrinsic value of $58.20 based on Graham's valuation. And as we can see, that is significantly higher than the current trading price, and the last time it was around that was around 2018. So we then move on to the multiples valuation model. Effectively here we're inputting companies in a similar sector, similar size: Altria, Turning Point Brand, Philip Morris, Universal. I'm sure you've heard of most of these. We input the stock price, earnings per share, and it gives us the PE multiples. We're then looking to get the average PE, which is 11.71, multiplied by the earnings per share for BTI, and this gives a price of $42.27. Again, upside to the current share price. Then we move on to our third model, the dividend discount model, where we input the yearly dividends for BTI over the last 5 years. And what we're looking to do here is effectively get the value of next year's dividend over the cost of equity less the growth rate in perpetuity. So as we can see, whilst there has been some years of growth, there is also a more recent cut, so we have to take that into consideration. On average, we have a growth rate of 2.22%. Looking forwards, I've gone with a bit more conservative than the average at 2%. Again, you could argue that it was just this year they had the cut and possibly it could return back to 4 years or 3 years ago when they were doing 3 to 6%. However, I've gone with a more conservative look, and this gives us a DDM price of $43.98. We then move on to our final model of the day, the discounted cash flow model, where we input the free cash flows over the last 10 years. And we have the growth rate year on year, which comes to an average growth rate of 12.41%. Now, looking for our future free cash flows, we use our growth rate. Now, I've gone again for a more conservative outlook at 1%. Analysts had estimates around 3 to 4%. So do bear in mind that these values that we get are what I've deemed to be more conservative, which gives us our future free cash flows and terminal value. Using our discount rate, we get the present value of these future free cash flows. We get the sum here, which we add the cash and cash equivalents. We subtract the total debt of BTI, and we arrive at our equity value. We then divide this by our shares outstanding to get to a DCF price of just above $70. So now we've gone through all the 4 models. As always, smash the like button, smash the subscribe button if you're enjoying the content. Do let me know your thoughts as you go along in the comments. So these are the 4 models that we have and the 4 values we've got from them. The intrinsic value today is based on the average of these 4 at $53.85. Now again, upside to the current share price and slightly above that 52-week high. Now what we're going to look here to do is get our margin of safety. Typically with companies that are strong that I like, I tend to look for a 10% margin of safety. However, with tobacco companies where I believe they're more on the decline, as we can see with the reducing volumes and the increase in their prices, I would go for more of a 25 to 30% margin of safety. Now, for those who would like a 20% margin of safety on a company like this, your acceptable buy price would be $43, which means you would be currently buying. Even if we put a margin of safety that I would be looking of 30%, you would still be buying at these current prices of $32. So in my opinion, it does show that BTI is currently severely undervalued. Now, just before we wrap up the episode, we're going to take a look at Wall Street price forecast. They believe in the next 12 months, the company will be going up to around $49.30, again showing significant upside to the current share price. So in my opinion, again, not financial advice, purely for information and education purposes, I believe BTI to be a current buy. Again, you have to understand though, with the market of cigarettes, volumes are decreasing and prices are starting to increase in order to show higher revenues year on year. Do let me know your thoughts in the comments. As always, smash the like button, smash the subscribe button. Do let me know your thoughts about this industry moving forwards. Do you believe it to be an industry that will wear out over the years, or do you believe that cigarettes will continue to be purchased and consumed by consumers? Thank you, and as always, have a lovely day.